Hey, what's up, guys? Just going to try something new here. Kind of jerry-rigged a camera onto something, I'll just say. And I'm going to try to see if I can do what the sectorial, what caused the 2008 ended up crisis. I've been told later on in this book, actually, that's why I came back to 6. I was reading that the reasons for the financial crisis can be explained in Chapter 6. So Chapter 6, as you can see, is called a Sectorial Accounting and the Flow of Funds. Now, if you're still not familiar, this is from the was pretty much widely considered as the modern monetary theory version of textbooks. So, anyway. So we have first is we have introduction. The sectoral balances, view of the national accounts, revisiting stocks and flows, integrating NEPA stocks, flows, and the flow of funds accounts, balance sheets, the flow of funds matrix. All this stuff will be explained in this chapter. So, if you like what you see, if I explained and read as well as I could, and you understood what this chapter was about, please consider subscribing. Please consider sharing, commenting, and liking. Also, you can visit realprogressives.org. We're having the year-end fundraiser, so you can go to realprogressives.org, and it'll be a big header on top of the website where you can go and donate however much you can in respect to the fact that it's the holiday season, so of course you probably spent a lot of money on gifts and dinners and all this stuff. But if you have a little bit left over that you'd be willing to donate, please consider donating to Real Progressives. Every penny goes to materials to educate the masses, to pay for the different platforms that we use on a non-profit level of those platforms. So every penny you donate helps with that. Without further ado, and by the way, no, I'm just so you know, I volunteer for them, but none of my content actually is sponsored by them or anything of that nature. I volunteer for them, and I help teach myself. I myself teach, help teach the masses about modern monetary theory, and so do other people, but I'm one of the younger lions of the sort, if you will. Anyway, so back to the sectoral balance, if I can get back. Okay, so let me see. Still jerry-rigged this whole thing, so let me try to back this up just a smidgen. Okay, so let's see. Okay, so unfortunately the focus on this camera is not very good. It sees this, but small print not so much. Either way, 6.1 Introduction. In Chapter 4, we saw that the national accounts dividend the national economy into different maybe it's divided. Excuse me. More messing up there. Anyways, and no, I don't. I don't edit anything. So, anyways, my mistakes are my mistakes. Different expenditure category: consumption by personal/households, investments by private businesses, firms, as well as individual residential investment in housing, spending by the government, exports to and imports from the foreign sector. The most basic macroeconomics rule is that one person's spending is another person's income, and income. Another way to state this rule is that the use of income by one person, that is, spending, will become the source of income for another person or persons. In this chapter, we extend our understanding of the national accounts, which record these different flows of expenditure and income. The sectoral balances perspective of the national accounts brings the uses of sources of national income together. We show that when appropriately defined, the sectoral balances must sum to zero. We expand our discussion of stocks and flows, and then introduce the flow of funds by references to the sectoral balances. Move this. There we go. Okay. Move myself a little bit. There are many useful insights that can be gained from an understanding of nations' sectoral balances. The sectoral balance approach helps us to understand the relations between the spending and income balances of the households, firms, governments, and foreign sector of the economy. For example, it illustrates that it is impossible for all accounts to run surpluses, that is, to save overall or spend less than their income. Simultaneously, for one sector to run a surplus, we need at least the other to run a deficit or spend more than their income. You will learn that for any of those nations which run external deficits against the rest of the world world income, you will learn that for any of those nations which run external deficits against the rest of the world, in order for its private domestic sector, that is, households plus firms, to run surpluses, that is, to spend less than income and save overall, it is necessary for the government to run fiscal deficit, that is, spend more than it taxes net of transfers. So in other words, because the United States government is the currency issuer, it needs to spend more into the economy, and in order for consumers to consume and businesses to get that money from consumers. If the government runs a surplus, that means it's taxing or cutting more than what people can spend. That's what happened in the 90s with Bill Clinton. He struck a deal with the Newt, who was, I believe, Speaker of the House at the time, to start cutting spending by cutting benefits that mothers, children, pretty much everybody who absolutely needed it, and cutting job programs and taxing more would balance a budget. Problem with that is, if you look at the definition of macroeconomics, it's basically the overall consensus of the economy as a whole, whereas in microeconomics is basically business cycle related activities. So you need the macro to feed into the micro in order for the IRS to take out from the micro, or from the micro. Anyway, let's see. The sectorial balances view of the national account. The Australian Bureau of Statistics publication Australian System of National Accounts Concepts, Sources, and Methods, or ABS 2014, is an excellent resource for understanding the background concepts that are used to derive the sectoral balance framework. The discussion therein is generally applicable to all countries. From the National Accounts Sectoral Balances Framework, economists derive what is called the basic income expenditure model in macroeconomics to explain the theory of income determination that forms the core of the so-called Keynesian approach. And it's in chapter 15, as you can see. The income expenditure model is a combination of accounting identities drawn from the National Accounting Framework and behavioral theories about how flows of expenditure by household, firms, governments, and foreigners combine to generate sales, which in turn motivate output and income generation. Okay, I want to make sure I had a full picture there. Let's see. Yeah, generation, yeah. Anyway, remember that an expenditure flow is measured as a certain quantity of dollars that is spent per unit of time. Conversely, a stock is measured at a point in time and is the net sum of prior relevant flows. The accounting aspects of that underpin the income expenditure model draw on several different ways that we can think about the national accounts. First, from the perspective of the sources of national income, we can write out the sources of total spending that flow into the economy over a given period using the following shorthand. 6.1. Y, I'm not really sure what that identity is right there, but Y, C plus I plus G plus X goes into M. So, total national income, GDP, represented by Y, is the sum of total final consumption expenditure, or C, total private investment, or I, total government expenditure, G, and net exports, X into M. Note the use of the mathematical symbol, which you see, which denotes an identity that is true by definition. You should also note that we have seen this identity previously as equation 4.1. You might refresh your memory as to that discussion. At this stage, we simply take these flows of expenditure as given and understand them to be parts of the national accounts of a nation. When these components of spending are summed, they equal aggregate demand for goods and services in a particular period. Aggregate demand, in turn, generates a response by producers, private and public, in the form of production, which in turn generates flows of income to suppliers of inputs into production, wages, profits. The sum of those flows equals the national national income. As we noted in Chapter 4, the trade account is also one part or aspect of the financial flows between the domestic economy and the external sector. We must include net external income flow, or FNI, which in that case is like net flows income external, or no, anyway, which arise from the dividend and income flows that accrue to investments that residents make abroad minus the dividend and interest flows that residents must pay foreign investors who have financial interests within the nation. Okay, I want to make sure I had all that. Okay. No, I don't think I had all that. And the camera side. Anyway, so let's see. As we noted in Chapter 4, the trade account is only one aspect of the financial flows between the domestic economy and the external sector. We must include net external flows. I think I read that part. I'm not sure. But just for your benefit, hopefully. External income flows, which arise from the dividend, dividend and income flows that accrue to investments that residents make. Shoot, I'm still on there. Okay, that might be just a little bit. Hoping I'll push this whole thing over. Okay, there we go. Okay. Sorry about that. Anyway, so let's see, which arise from the dividend and income flows that accrue to investments that residents make abroad minus the dividend and interest flows that residents must pay foreign investors who have financial interests within the nation. Adding in the net external income flows, F&I, to equation 6.1 to GDP, we get the familiar definition of gross national product, or GNP. 6.2 GNP, I guess that's by definition, C plus I plus G plus X to the M plus FNI. At this stage, we could make the analysis. I better twist this up. At this stage, we could make the analysis quite complicated by considering retaining earnings in corporations and the like, but here we assume that all income generated by firms and corporations ultimately is received by households, that is, there are no earnings retained by firms. To obtain the sectorial balances form of the identity, we subtract total taxes net of transfers, T, from both sides of the equation. 6.3. Let me see. 6.3 GNP, gross national products, minus T, transfer, equals C, consumer, plus investment, plus government spending, plus I believe it's exports, then go to minus imports, plus FNI, which again that would be, where is that? External net external income flows, minus tax, I'm guessing, or just transfers, one of the two. The transfers, I think. Anyway, now we can collect the terms by arranging them according to the three sectorial balances. G.4, G.6.4. Wow, G.1. Anyway, I'm already losing it. Anyway, so GNP minus C minus T minus I by definition, is G minus T plus X minus M plus F and I. The terms in equation 6.4 are relatively easy to understand. Now, the term GNP minus C minus T represents total income less the amount consumed by households less the amount paid by households to government in taxes net of transfers. Thus, it represents household savings. The left-hand side of equation 6.4, GNP minus C minus T minus I, thus is the overall net savings of the private domestic sector, which is distinct from total household savings S, denoted by the term GNP minus C minus T. In other words, the left-hand side of equation 6.4 is the private domestic financial balances, or savings minus investment. If it is positive, then the sector is spending less than its total income, so the sector is adding to its stock of net financial assets. And if it is negative, the sector is spending more than its total income and running down its stock of net financial assets. More generally, we define assets as items owned by households and government and government and non-government organizations which have value. These include financial assets such as holdings of the money of account, bank deposits, and shares, and real assets such as capital, equipment, land, and property. See, this is what happened in 2008. Anyway, on the other hand, liabilities can be held by the same entities and represent financial obligations which need to be settled over over time by some form of payment, which may take a financial form through the transfer of bank deposits or shares, or a real form, namely goods and services. Note that by rearranging equation 6.4, we get another version of the sectoral balance equation. 6.5. So that would be, looks like savings minus investment plus transfers, or maybe it's taxes, one of the two, minus government spending plus and minus CAB in zero, which I forgot what that CAB is. Like, it's, I know the last part is balance. Maybe it's current account balance. There we go, current account balance. The term T minus G is the government financial balances or primary fiscal balances, and is in deficit if government spends G is greater than government tax revenue, or T. Okay, so this happens to me as tax, not transfer. Revenue tax, T, and in surplus if the balance is positive. Finally, the other left-hand side bracketed term minus X minus M plus F and I is the negative of the external financial balances, commonly known as the current account balance. It is, got that right finally. It is in surplus if negative and deficit if positive. It is the balance between the spending income flows of foreigners in the nation and the spending income or / income flows by residents that go to the foreign nations, to foreign nations. More simply, if the final bracketed term on the left-hand side is positive, then there is a current account deficit, or COD. Anyway, CAD. From equation 6.5, we can see that the private We can say that. I'm not sure if that's anyway. The private domestic financial balance plus the government financial balance plus the current account deficit equals 0. In other words, they're supposed to be balance themselves out. That this is an accounting statement. For example, let us assume that the external or foreign balance equals 0. Let us further assume that the private domestic sector's income is 100 billion, while its spending is equal to 90 billion, which delivers an overall surplus of 10 billion over the year. Then from the identity equation 6.5, the government sector's fiscal deficit for the year is equal to 10 billion. We know that the private domestic sector will accumulate 10 billion of net financial wealth during the year, consisting of 10 billion of domestic government sector liabilities, given that the external balance is 0. As another example, assume that there is a current account deficit of 20 billion, so that the spending income flows from foreigners to the nation is less than the spending income flows from the residents that go to foreign. Now I get to do this. Nation. As at the same time, yes, assume the government sector spends less than its income, running a fiscal surplus of 10 billion. From our accounting identity, we know that over the same period, the private domestic sector must have run an overall deficit equal to 30 billion. 20 billion plus 10 billion. At the same time, its net financial wealth will have fallen by 30 billion because it sold assets and or issued debt. Meanwhile, the government sector will have increased its net financial wealth by 10 billion, reducing its outstanding debt or increasing its claim on the other sectors. And the foreign sector will have increased its net financial position by 20 billion, also reducing its outstanding debt or increasing its claims on the nation's residents or government. It is apparent then that, as noted previously, for one sector to run a surplus, at least one other sector must run a deficit. In terms of stock variables, in order for one sector to accumulate net financial wealth, at least one other sector must be in deficit. It is impossible for all sectors to accumulate net financial wealth by running surpluses. And I'm going to leave it there for right now. I'm trying to do 30 minutes only on these things. So, anyways, I'll be back on the later date to continue this. Once again, oops, a little shaky there. Once again, if you can, please go to realprogressives.org and donate what you can. Again, it's understandable that you may not be able to donate as much as it was the holidays and it's the last few days of the year. So, but if you can donate to at least $5, then that would be nice. But there is a thing where if you donate $100 or more, you get a free T-shirt. So, and all donations, I believe, are going to be matched by an outside donor. I'll just say that. Anyway, but thank you for watching. I hope you found this educational, as that's the goal of this of my content here. And also, feel free to look up modern monetary theory, look up realprogressives.org, and look up a textbook by L. Randall Ray, Martin Watson, and Bill Mitchell. And it should come up as a blue book, macroeconomics, and I believe they came out in roughly 2018, 2019, some to that effect. Anyway, but get that if you want to understand how macroeconomics works outside of the normal mainstream. I believe you'll find that if you understand it slightly, then you're doing a lot better than half the economists out there. Anyways, for now, thank you and peace out for now.